So when we talk about investment, the investment can be done in the form of FDI, investment can be done in the form of FPI. FDI stands for foreign direct investment, FPI stands for foreign portfolio investment. Now we are at the age of globalization, liberalization and internet. We have global internet connection. We all are connected with one another, where we have a market which runs around 24 hours. We have 24/7. We have market keep going on. Forex market is full OTC based market. So all the days you have trading in the market, and you either you sitting in India, you can trade in US exchange. You're sitting in US, you can trade on Chinese exchange, irrespective of the time, irrespective of what exchange you are trading. So many mechanisms are being provided by investment banking companies. We have brokerage house which gives us the flexibility of trading in different market all over the world. So in the age of stock exchanges, where the stock exchanges are developing at the advent of the development of information technology, we are seeing a lot of scenario of an MNC having presence in different part of the world. And in order to get the popularity, in order to get the advent of the popularity, where they can get the monetary benefit of the popularity, what many companies will do, many foreign companies, they'll try to list themselves in different stock exchanges all over the world. But when you talk about the listing of stocks in different stock exchanges, you need to list themselves, you need to list your security in the local currency. You cannot list your stocks in the currency at which is trading in the local, in the market where it's trading. So maybe suppose Infosys is a company which is trading on Indian, it's an Indian based company. Infosys is an Indian based company. So it is already listed on Bombay Stock Exchange, National Stock Exchange. It's trading in Indian rupees. But if the Infosys think of listing themselves in the US stock exchange, then they have to list themselves on the US dollar. They cannot list themselves on US stock exchange in Indian rupee, because the rupee is not tradable in USA. Dollar is tradable in USA. So if you are thinking to list yourself, you have to list yourself in the dollar. Then when you talk about listing and all this, the listing to get the fund to raise stocks in the form of shares, these all comes under equity instrument. These all are the part of equity instrument. And when you talk about equity, equity is a mode of raising fund from the market in which you transfer the ownership. In the case of debt, debt is very easy. If you're looking for fund in the market, maybe India is not good place where you can get the money. Maybe you're an Indian based company, maybe the interest is very high in India. You go to US, you go to France, you go to Japan, where the interest is low, and you can raise money in the form of ECB, external commercial borrowing, or FCCB, foreign currency convertible bond. You can borrow money from them. You can pay the interest either in that currency in which you borrowed, or maybe in dollar you can pay the interest. But the benefit here there is that interest is low, and you can get back the money, and you can invest the money and for your own ongoing operation, and possibly in cash, and possibly in the future, once you get a reasonable cash inflow, you can go ahead with your with the payment of the debt, and you can get back the fund. In the case of debt, you never transfer the ownership, so it's not a problem. But in the case of equity, the ownership is transferred, so that way the equity become complicated. In the equity instrument, when you talk about ordinary shares, I'm not talking about preference share. Ordinary shares are irredeemable equity instrument, where the ownership what to transfer, that having the infinite life. So what is a guarantee that the money what you take in from the investor, retail investor, you'll use for the best interest? What is the guarantee that you will not run away from the money? So in India, we have body like SEBI which take care of everything. But imagine Indian based company, if they go to US and they raise money from the US market. So again, there the risk become multiplied. Fine. So such situations, when you talk about the international equity instrument, then the international equity issues happen in the form of depository receipts. Those deposit receipts are like in the form of ADR, or they are in the form of GDR, American deposit receipts or global deposit receipt. So if you raise money from the American stock exchanges, then that is being done under in the form of ADR, while if you raise money in the form of maybe in London market or maybe over the Luxembourg market, then it is being done in the form of GDR, Global Depository Receipt. The overall logic is same. It being done where instead of talking in the term of share, we talk in the term of depository, because share is already being issued in India in rupees. So Infosys, if they're looking to raise money from the American Stock Exchange, so possibly they will issue in the form of DR, depository receipt, where one deposit receipt can be one share or it can be multiple of the share, practically, where they need to trade in the dollar. So whenever a company follow ADR or GDR issue, that is being done under 3 levels: level 1, level 2 and level 3. In the level 1, they particularly target the OTC market. The retail investors are not allowed to participate in the case of level 1 of ADR or GDR, where a company or maybe some brokerage house signing a non-obligation, possibly no problem certificate from the company, no objection certificate from the company. What they can go, they can buy certain number of shares from the Indian Stock Exchange, maybe of Infosys, and they go to US and they can sell those shares in the name of deposit receipts, which is being trading in dollar in the OTC market. So that is something called level 1, where they don't have to follow much registration phenomena. They don't need to work under the SEC norms and regulation, because certain HNIs and all, they'll sell those shares in the name of deposit to them. But in the case of level 2 and level 3, they raise money from the primary market, and also they list themselves on the American Stock Exchange. So they need to follow SEC or other capital market regulator, the laws and regulation. They need to disclose the book of account. Indian based company which is disclosing the book of account in India by following Indian GAAP parameter. So they have to reflect the same book of account to the American investors in the context of American accounting policies, so that they can understand what is being written in the annual report. And so those things, those phenomena, those conditions, they need to satisfy, where they need to keep disclosing the book of account after every quarter, or maybe after every annual or half yearly, depending upon what the American Stock Exchange is telling to them, depending on what FASB, Financial Accounting Standard Board, is talking for the issue of deposit receipt, what need to be done in America. They have to follow that guideline, and by following that guideline, they can raise fund, and they have to register themselves with SEC. They have to disclose the book of account on periodical basis to SEC. At the same time, any form of communication, any news, corporate news, what comes about the company, they have to disclose to the American clients what they have, who had done investment on your shares, because those American citizens, if they think to do investment in Indian stock, they have to pay some fund to the American investment banking company. For that, they charge a brokerage. Again, they will convert a dollar into rupees. Again, they'll convert the rupees into dollar, and again they convert the dollar into rupees and invest in India. And then in India, they have to follow the Indian norms and regulation. Again, if they think of selling that, they have to pay long-term or short-term capital gain tax, which is higher figure. Again, they have to convert the rupee into dollar, and then on that again they charge commission, and again they get. So this phenomenon become very complicated, and sitting in US, you cannot understand what is happening to your stock in India. So since you know that you are very popular, imagine Infosys, TCS, Satyam, they are very popular company in US or European market, and a lot of US people are working into that company. So in order to make themselves more employee friendly, in order to give a sense of belongingness to their employee, or maybe those who are interested to get themselves to the product what they're looking for, the shares are being issued in the name of deposit receipts, and that need to trade it in the currency in which they are listed. And either in that you can have level 1, level 2 and level 3, and depending upon the situation, depending upon the fund requirement, depending upon the capital market regulator, they have to follow the laws and regulation, and then they need to follow that guideline, and they need to work under that guideline. So whenever they raise money in the American market, so possibly when you look into the way the MNC do their operations, and the way they want visibility, they want attention, and so that attention you can do in marketing sense, or that attention you can do through financial market by issuing yourself in the foreign market in the term of deposit receipt. Like a Standard Chartered Bank, it's a UK based bank. they issued IDR, Indian Deposit Receipt in India, and they listed themselves on Indian Stock Exchange, particularly in rupees, and they're trading in rupees. So there are these conditions, there are this situation which you keep witnessing. These situations, when you work on the way the MNC do their business, the ongoing operations, what they work on, many times they follow the concept of transfer pricing, where they try to do siphoning of the fund, where the tax rate would be, the country where the tax rate is high, they try to overestimate their cost figures, or they try to convert the siphoning of the fund, then they'll try to save funds so that they can save from the payment of tax. And they have subsidiaries in different part of world, so they can show some transactions which are not real, maybe that factual transaction between the two subsidiaries, by overstating their cost figure so that they can reduce the profit figure, and thereby they can pay the less tax. And then they'll go to such country where the tax rate is low, maybe certain country which have signed double taxation avoidance treaty, those islands like Bermuda Island, Cyprus, or maybe Cayman Island, and there they overstate their cost figure. There the taxation regulation, the accounting regulation not much stringent, so they can overstate the figure and the tax rate is low, and by that way they can convert the black money to white money. So a lot of norms and regulation, lot of issues happening because of transfer pricing, but still it's a controversial word, it's always be there in the financial market. So I hope you people understood the discussion on global financial management. So this make me to end the session on global financial management. I try to cover the sections on global financial management, topic by topic wise. We discussed lot of topics. At the same time, I have taken the application of MS Excel. I took MS Excel and all the problems I did in MS Excel, so that I can give you the practical implication of this subject. So I hope you understood this context of discussion. So keeping that faith in my mind, I'll wind up the session. Thank you for listening. Take care. Bye.